What's going on, everybody? Spencer Gray. Welcome to the Gray Report. If you're a multifamily investor, active, passive, you're in the industry, good news, you're in the right spot. Every single week on the Gray Report, Matt and I break down all the latest research reports, news, data, centering around the multifamily industry, commercial real estate, macroeconomy. So again, if that interests you, stick around. We've got a great episode. Make sure you like and subscribe to this channel so you can get every single update that we're putting out. Again, we're bringing in all the most important data because you don't have time to. And a lot of these sources, they kind of hide it. They don't always putting it out there the way we think that it should be. That's why we started doing this, aggregating all the best information, bring it directly to you. Got us some really great kind of end of 2023 into 2024 reports. Really cool piece from Reuters. Great article from Cushman & Wakefield looking at the 10 critical questions for 2024. I've gone through the list. Matt's gone through the list. These are the same questions that you're asking. What I like about it is they actually make some really specific calls, not jump around too much. Also got a piece from RealPage, rents flat as supply surges. Going to get into not only the supply side, but the demand side as well. It's so important looking at both sides of the coin. All right, strap in. Let's get into it. All right, welcome back to the Gray Report. Dr. Matt Bosnagel, Happy New Year. What's going on, Matt?
Oh, nothing. We're busy here. I don't know if you could tell, but it seems like everyone got started on the new year really quickly. There was no groggy 2024 at the start of it. It's been exciting from the get go. So people are still thinking and nervous.
Yeah, I think January 2nd, I felt that the energy just turned back on. People are determined, make some good decisions, make some investments. 2024, still a lot of questions, man. Kind of where we're going. A lot of uncertainty, kind of at this moment where we're discussing, if and when the Federal Reserve is going to pivot, lower interest rates. Is there going to be distress, or kind of how much? What is that going to look like in commercial real estate, the multifamily market in particular? How is supply going to affect rent growth, occupancy? And are we at the bottom? Are we near the bottom? What's the outlook? How do we make some decisions this year? Because I think everyone is looking forward to moving on from 2023, where, sales volumes were down 68% compared to the previous year. Had negative year-over-year rent growth. You might see that again, this year, even though I think there's calling for more, like I think your call, Matt, is 2.5%. So I think, we're on the precipice of the unknown. Recession is still as a question mark around it. But the energy, as we've talked about in the past, Matt, feels different from the last year. I think we're done with the doldrums, even though it's still winter. We're ready to break out and get things moving. Matt, there's a lot of interesting year-end, beginning of the year reports coming out, analysis, assessments. Kind of sum it up. What's the mood that you've noticed as you've been reading these reports, analyzing these reports? What's the mood? What's the sentiment? Aggregate it up and give us your thoughts.
So, I'll tell you this common thing that I've been thinking about a lot, and really has been repeated in all of these different reports and forecasts specifically. There's this assumption that things are going to get bad in 2024 and then they'll get better, whether that's in 2025 or whether it's in the second half of 2024, whatever. There across all of these different levels, when you're specifically within the apartment market, there is this idea like it's going to get worse before it gets better. Apartment values will go down, maybe then they'll go back up later. Rent growth will go down, then they'll go back up. Interest rates and apartment supply will stay elevated, then they'll go back down. The economy is going to cool down, and then it'll bounce back up. The timing of any one of these things is going to be different than the others, but a lot of them are connected, either like causally or just, especially if it's things like apartment supply or an economic downturn, that can affect rent growth in different ways, but still, has that correlation. So hypothetically, you can maybe time it. And that's what I'm thinking about is is how important and really how risky it might be for multifamily investors that want to get this timings just right. And so, I've got some hypothetical questions and stuff about, what would happen if you got caught on the wrong end of it. And a lot of this seems to boil down to interest rates. That's what I'm thinking about, and that's the subject of this first article from Reuters. Is if you're trying to like get ahead of interest rates, and that can leave you a lot more vulnerable than if you were trying to maybe predict rent growth or something like, or just enter into a discussion with another with an apartment seller. You can negotiate a price, but you can't necessarily change the Fed's mind. So there are things that are inside and outside of people's control, and I just see this potential risk of. Okay, and so let me just boil it down too, because I'm all hot and bothered.
Yeah, let's go.
So just hypothetically, let's say that most multifamily investors and institutions are on the same page. Things are going to get bad, then they'll get better. Now, if these investors were 100% confident that these trends would play out in the apartment market, if you knew the future, then of course you'd be happy to make an apartment purchase, even though valuations could decline in the short term. But then let's kind of drill down even further. I mentioned how apartment supply is expected to flatten rent growth. That's kind of one way apartment valuations could be lower. But the other factor is like the difference between throwing cold water or jet fuel, or flaming jet fuel, I don't know, on the market, which is interest rates. So much of the shift from getting bad to getting better depends on interest rates, like I mentioned before. Saying that they affect the economy is almost cliche, but it's the pivot point between good and bad, whether you're talking about the economy or you're talking about the specific capital markets for multifamily. So if you want to get ahead of this, and you make a prediction that, let's say, interest rates are going to go down to 2.5% in by the end of 2025, which isn't like a wild guess. But if you get that wrong, instead that they're 4% at the end of 2025, then you get the worst of both worlds. You try to survive this temporary hardship, and then the relief never comes. It just stays being hard. So that's what I mean about like the risk. The real risk is like, okay, if it is higher for longer, and you made a bet that then it's real misery that you might be facing.
So what you're saying, Matt, is, and what I'm hearing, and I think it's really smart, and I think folks should take note, is that if you're looking at an investment, whether you're a GP putting a deal together or a limited partner evaluating a deal, if certain things have to go right that you're not in control of, if you're counting on certain macroeconomic events, you need interest rates to come down to a certain level to achieve your not just your target, but to hit even break even, or to get an acceptable return. There's a significant degree in risk, and you might get it right. Investors might get it right, and maybe they thread the needle and rates come down right when you predict. But I mean, 80 to 90% of economists, man, have and inaccurately forecasted the economy over the last couple of years. So to think that all of a sudden you're going to be, something, one, you have the superior knowledge and foresight to outpredict 80% of economists. Well, I mean, maybe you can, and props to you, but come on, like, let's get over our ego a little bit and like admit that we can't predict the future. Like, we don't know. And if you're unhappy with what the deal how the deal would look if conditions remain the same. For example, so if cap rates stay where they are, right now, then they're in the mid 6%. They're 6%-ish, 5.5% to 6%, depending on the location and the vintage. Just say, if that doesn't work, if you need a 5 cap on your exit, that's concerning. There's some risk. Can you get the 5 cap? Certainly, I think there's a good chance we're going to go back to 5 caps in the next couple of years, maybe even some sub 5 caps. But I certainly not going to bet the farm on it by any means. I'm not taking those types of calls because I don't think that I'm that smart or that intelligent, or I have some superior knowledge base. Same thing, I need interest rates to be at a certain level to refinance in 2 years. Well, yeah, are rates going to come down? Yeah, I think so. Probably most people will say that they will. But now we do this every week. And we joke that, the narrative on where rates are going changes every couple of weeks. And the 3-week mark is here. Maybe it's it's plus or minus. 6 weeks ago, or now going back further than 6 weeks ago, when the 10-year Treasury was brushing up against 5%, the overall consensus was higher for longer. We're going past 5%. We're going to see much higher rates for a much longer period of time. Then all of a sudden, weeks later, the 10-year Treasury collapses and falls. Jerome Powell makes a huge, pivot, saying we're probably, we've done some good work on inflation. We're probably going to lower the Fed funds rate next year. We're thinking about it at least. Now the 10-year Treasury is down from 4%. The narrative was rates are going to be coming down so quickly. Everyone, is off to the races. The stock market was taking off. Now the narrative's changed again, and that's what this Reuters piece is really getting into. Is really saying that there's a, again, it's not, higher, is relative, but again, there's somewhere in the speech is money markets are seeing Federal Reserve keeping interest rate above 3% for years. Now 3%, is 200 basis points, more than 200 basis points below where it is today. And I think a Fed funds rate in the 3% range would be, relatively accommodating relative to where it is today. But again, government spending and other inflationary pressures, including the job market and the labor market and wages. I mean, we just had an incredibly strong jobs report come out today, Matt. I think 218,000 jobs were added, which was a big surprise. And it's going to be probably revised down, but still a lot more jobs than was anticipated. That's good news for the folks getting jobs and higher wages. It's bad news for inflation, which is a hidden tax on consumers. Anecdotally, talked about this last week, Matt. So we didn't really predict it because we didn't make a call. We don't usually to do that, but we said, I'm looking around, and again, it's the service industries. No one has enough staff. No one is working. Everyone's trying to hire, and there's labor hoarding going on of saying I can't fire these folks, even if I don't need everybody right now. I can't even afford it, but I can't afford not to have the staff that I have right now. I have to pay them top dollar if I want to operate.
Yeah, and that's what I was like. Labor short. People say labor shortage. Just say labor's more expensive now. It's not like the labor short. It's like if you raise your wages enough, and that the cost of labor is increasing.
Well, sure. I think it's a good point, but I think that, there is a shortage of labor at prices that business owners want to pay. And you're right. Yeah, if you raise those wages, which again is what I'm saying, the wages are going to have to rise because I've been in so many restaurants. Again, this is anecdotal, but I noticed it in the pandemic at the same time, and it foreshadowed a little bit of the extreme growth that we saw in wages. Is that, I mean, you can't find enough people. People are finding jobs elsewhere, better paying jobs. The service industry, retail, working in restaurants, that's hard. That's hard work. I know you've done it, Matt. I've done it. It's like long hours on your feet, and there's, if you can make a better wage doing or similar, doing something different, people are going to do it, and so that's going to continue this, or at least fuel this idea of a wage price spiral or a feedback loop. And from the beginning, the Federal Reserve was raising interest rates to try to tame inflation, and really the only way to do that is to tame the labor market. Now the demand side is kind of corrected on itself, and we're seeing kind of normal demand. We're not seeing all the supply bottlenecks and pressures, but things are still cooking really, really hot, and so it's going to be harder for the Federal Reserve to lower the Fed funds rate if they're seeing inflation, well above their 2% target. We're still at 3%, and if they want to get to 2% average, they have to be really below 2%. Now, we're going to get into this a little bit, Matt, but there's a lot of calls for recession in 2024. In the Cushman & Wakefield piece that we're going to get to in a minute, they're calling for Q1 2024, which, I mean, that
sounds a whole lot like last year.
Sounds a whole lot like last year, but also we're in Q1 2024 right now.
Exactly. Yeah, I know.
I had to think about it. I was like, that's today. We're not Q4 is gone and went. So like 2 months, 3 months, like.
Well, and sometimes I do think about motivated reasoning about, a lot of people are really counting on recession and the aftershocks of what a recession would be, which would be lower rates that could, help people to invest if they wanted to. But there are, again, like there are so many things that these predictions are structured upon. And one of the linchpins seems to be a recession from which a lot of different things, especially lower interest rates would follow.
And we know that, I mean, prices, and they get talking specifically about the multifamily market, commercial real estate. The anticipation of the distress and the opportunities, in a way, precludes the market from creating those opportunities because everyone is so excited and so confident about the other side of the dip that it prevents the dip from happening in the first place.
That is exactly what I was that you phrased exactly what I was trying to get like in the long way around earlier when I was talking about like timing the market. Like if everyone's timing the market, then there's going to be no timing the market. Then they're just
Yeah. It's all going to be, it's all the recovery is priced in. There needs to be much more pain and uncertainty. And, because everyone is reading this, everyone's subscribed to the Gray Report, Matt. They've been getting newsletters, they've been listening to the podcast, and make sure subscribe to it or not. But then we've been talking about how the supply is going to, we're going to hit peak delivery kind of, throughout 2024. We're going to be delivering the most apartments that we have delivered as a country since 1987, like incredible amount of new supply. But then it basically deliveries fall off a cliff mid 2025. Not at the beginning of 2025, it's mid 2025. And again, deliveries can kind of get pushed around a little bit, but by mid 2025 to 26, the supply is going to, completely cook off. It's going to take about 3 years, according to Jay Parsons from Real Page, to absorb all of the supply that we're seeing right now. And by the way, demand is actually pretty good. Yeah, supply is again, 30-some year high, but demand, it's not as though demand is taking a nosedive. And in fact, demand's, it is strong, if not just at kind of like the average where it typically is. And so it's going to take a couple of years to absorb this new supply. But everyone knows that on the other end, it should be gravy. So again, it prevents this dip, which is great for existing owners of multifamily properties. It makes acquisitions continuing to be a challenge because there's still so much competition in the market, suppressing returns because everyone loves multifamily, even with all those challenges that it's had. Resilience is really fascinating.
I will like kind of caveat. So that's like my worry is that everyone is trying to get ahead and they can see past the, the dip and they could see the sunny thing on the other side. But ultimately, and this is kind of proven out because things haven't picked up in 2023. Ultimately, I don't think that investors have yet tried to get ahead of these rate cuts and are like getting really aggressive because valuations have declined. So like, I don't know, like they're still at the same time, there's still this nagging feeling and that I want to plant in people's heads that, for every deal that a multifamily buyer gets outbid on, is that because the outbidder knows that interest rates are going down soon? Now I'm saying no here, ironically, but it may not be everyone's like feverishly getting ahead, but like there is, that's part of people's logic. It seems like, and that is an ingredient in their logic that may be misplaced if they are, really hoping for relief. And the other thing I wanted to mention too is not just that interest rates could go down to 3%, but that 3% is still elevated. People have been dealing with interest rates below 3% for about 10 years or really even more. So the normal for interest rates is like people are, I can't wait for the normal. The normal will be different now for the next 5 years. What this Reuters thing is saying is for the next 5 years, we could be in the 3.5% to 3% range, which was not true for the past 10 years. And so like, I think people are going to be doing business and running their spreadsheets with completely different assumptions.
Well, 3%, So like on a bridge loan, if we're at a 3% Fed funds rate or call it 3% SOFR, you're still looking, if you have call it a 300 basis point spread, that's still 6% interest rate. That's relatively high
Mhm.
for a floating rate short-term loan. Fannie Mae, Freddie Mac, it's going to be a little bit less. You're probably going to be dealing in kind of the mid 5% range, which there's already been some lending at the mid 5% range. And then where the 10-year
Mhm.
treasury, that's a little less, certain. But if it's lower, we're still hovering around 4% right now. So, rates are in the, mid fives or so, spreads kind of in the mid, call it 130 to 180 basis points, depending on the
Mhm.
year and the term and all of that. Might be off a little bit. If you're a lender, let me know in the comments. But so, and we've mentioned this a couple times, Matt, but to get the kind of relief that some folks are really looking forward to, rates have to fall even further.
Yeah.
Now, it's going to benefit some that values maybe don't decline nearly as
Mhm.
much because there's a lot of demand in the market. That's going to help on refinances and in sales. But again, the acquisition space, investors are going to have to be more willing to accept, kind of more middle of the road returns, knowing that, hey, there's a real chance here that there could be an upside surprise. But kind of the base
Mhm.
case, as we're talking about earlier, is going to be lower than we've seen the last 10 years.
Yeah.
The only way to produce, significantly outsized returns is to kind of really go out on a limb and speculate, which I think is totally fine and appropriate to do as an exercise to see where that investment could go if certain conditions are met. But if you're doing that, you got to be doing the opposite of, what if conditions deteriorate, try to not a specific black swan events, but, materials kind of slow down in the economy,
Yeah.
more supply coming online than we've anticipated. I think stress testing and underwriting to a variety of different scenarios is really appropriate and gets you out of that kind of mono model of here's just we have one
Yeah.
model of assumptions that this is the way the deal is going to work. Because in reality, again, we can't predict the future, and we certainly can't accurately predict with great accuracy, the many dozens of assumptions and inputs that goes into a
Yeah.
long-term, multi-year financial model and forecast.
Yeah. And
So
and
look at a
even,
lot.
some of them are more predictable than others. Even like rent growth, you can find the markets maybe that are more resilient, but there are some things that are just too big. Maybe if you have if Jerome Powell's cell phone number or something, you can get a tip on where interest rates are headed, but probably not for most investors. Now we're barely there. I think we're making close friends with Jerome Powell. Pretty soon I'll get his cell phone number, but I don't have that yet, and so I'm not going to count on specific knowledge of where interest rates are headed.
I think you'd get
And again,
a shut the effing door response for giving my clients some
yeah. That's right.
Um,
Uh, yeah,
Matt, you want to move on to this real page piece talking about
yeah,
supply
definitely.
because
Yeah,
it's such. I mean, I think it ties into trying to understand what the market's gonna look like over the next couple
yeah.
of years,
And in a
and
way,
yeah,
it's a little bit more comforting because we have a view of this. This is not speculation. Apartment supply surging to highest levels since the mid 1980s. This thing is gonna happen, and I think that the silver lining for something like this is is that we do what, like you said before, we have had enough demand that has absorbed this to the point the apartment market isn't crashing, rents aren't crashing, they are stable and stagnant, but that is because of the high demand that we've had to absorb a lot of the new units that we're seeing, but really historic levels. And from a renter's perspective, it's great news. But this again kind of underscores this story of temporary, difficulties for investors and operators, and longer term, there's something just beyond the horizon. There, the supply will get cut off, but we've got our work cut out for us, basically, in 2024.
I just wanted to highlight a couple of these charts because they're really great. First, starting again, if we're talking about supply, but also, demand, it's relative. And looking at this chart, looking at first 4 quarters of 2023, then also comparing to the average absorption since 2000. And we had a really strong fourth quarter, a
Mhm.
decently strong year. We outpaced the long-term average in the first quarter. We missed it a little bit in the second quarter, which kind of makes sense. I mean, that was really the period where you would like to see a lot of rent growth. We just really didn't get it. In the third quarter, though, we again outpaced the average, absorbed 91,000 units. But the fourth quarter, it was a total outperformance compared to the average. We absorbed 58,000 units. On the average, again, fourth quarter, people stop leasing apartments after Thanksgiving. A lot of times, kids in school. Usually, it's a minus 11,000. We actually absorb again 58,000. So the demand side is strong, but we just have to get through the supply deluge.
Yeah.
We're occupancy, has finally come back down to kind of average, long-term average levels. And I think, Matt, last year around this time, I hope it wasn't all the way back to 2022, because that certainly wasn't the case. Maybe it was, but again, we the period of normalization or so,
Mhm.
from just the madness of
Yeah.
2000, 2021, and a little bit of 2022. This is that normalization and the mean reversion. But I think what we're seeing in real time, not to get too technical, but I think we're seeing a lot of support. We're not seeing a trend to the downside in a
Yeah.
period of, again, decade supply being delivered, and so slightly above average demand. We're seeing a ton of resilience. We're not seeing things drop out, and this is setting up, I think, an interesting opportunity for solid performance over the next 5 to 7 years.
Yeah.
But again, going back to what we said a couple minutes ago, we're not talking about this, Matt, in a vacuum. We probably should have, not shouldn't tell anybody this, but every investors know this. They're aware of it.
Yeah.
There's a lot more, especially since I started investing, Matt, of apartments kind of back in 2015. The market's much more efficient in terms of data and information. Again,
Mhm.
before we started the Gray Report, people weren't reading, that there weren't the access to data and analysis wasn't anything like it is today. Like, there would be some reports and market summaries, and I mean, they would have obviously absorption and supply and projected rent growth, and people were certainly doing that work. But it's not like everybody had access to CoStar. Not everyone was reading the reports. They were kind of hard to find. But now with LinkedIn, real estate Twitter, which was all around then, but it's being used so much more today, at least in my perspective. Again, I guess you tell me if I'm completely off base and I just wasn't paying attention. Maybe that, but my perception, people are a lot more aware of this data, and I think the Gray Report a little bit has had something to do with it. There's great resources out there also in addition to the Gray Report.
It's I mean, from my perspective, it does seem like the pandemic kickstarted a lot of this reporting that we're seeing, even from places like Apartment List. They started before the pandemic, but it does seem like the push for monthly rent growth and occupancy data pushed out from all these different sources, that it seems like someone lit a fire under them during the pandemic, because there's a wealth of information available. It's just you just kind of have to chase it down. And speaking of the Apartment List report, it does kind of pair well with a lot of what you're discussing here, particularly this idea of a kind of normalization and a shift. The rent growth is wobbling, but it is wobbling towards towards the historical averages. And and I don't know if we can skip to the Apartment List, but if you're looking at the month over month change in national rent.
let's save Apartment List. Let's save Apartment List to next week.
Oh yeah. I'm sorry.
You're
But
good.
so just to summarize this, and this is a good teaser. But if you look at if you're looking at this information about month over month rent changes, the rent changes in the end of 2022 were a little bit steeper. The declines were steeper than what we saw at the end of 2023. So it was harsher in 2022. We didn't see that in the year-over-year numbers because the first half of 2022 was doing so well. But actually, that winter was worse, or that fall and winter was worse in 2022 than it was in 2023. It's kind of like, you drop a pebble in the waves are getting smaller now, and
Yeah, no,
we're still
Matt,
adjusting.
just because we can't not show the graph now that it's been
Yeah, sorry.
no, this again, it's just a teaser for next week. Next week we're going to feature a much deeper dive of this apartment list report. It's their December report, but Matt's 100% correct. Last year in 2022, much weaker second half of the year. Now, it was also led by a much stronger first half of the year, as you can see, January basically through July, maybe a little bit of August. We had a much weaker beginning of the year. We never saw that real kind of peak growth in the summer or spring and summer months, and certainly had a slow fourth quarter. But as another one of these charts will show, 2020, we saw even lower rent growth than 2023, which is down for an apartment list, and the change of the median rent on average, the median rent, which is good metric to look at. 2023 are down by 0.7%. Now, of course, that's compared to 2021 when we were up by 17.6%. Matt, it's interesting. We're basically over the last 3 years, rents are up about $250.
Mm-hmm.
Which is a lot. But it's interesting because of all of the business plans of multifamily investors in generally, like a value add
Mm-hmm.
business plan, I'd say the average target rent premium was around $250. And so just struck me as it's like, okay, well, that's not a shocking number, I guess, because that was kind of what the plan was for a lot of operators. Achieve that, but certainly just not through the way that originally had anticipated by any means.
Yeah.
But
It's
Matt,
it's gonna be interesting to see how this goes. And one thing I would like to add too is, yeah, rents were lower or the rent declines were sharper in 2022 versus 2023, and 2023 had significantly more apartment supply. So not only was it fighting,
yeah,
was it reacting, it was fighting against that, and well, maybe winning a little bit. Now it's all relative, but
no,
there's room to say
that's no, really good point. I mean, again, I think obviously kind of a weaker growth because of that supply. That's the big difference. But I think relatively resilient. With with a 36-year high in apartment deliveries. Matt, I'd like to
Yeah,
just hop over to this Cushman and
let's
Wakefield,
do it.
these 10 critical questions for 2024. I think that these are 10 questions. There's a few that we'll probably spend a little less time on. But I think these are all the questions that people are asking, and they're giving some answers. And so let's take everybody through them. First,
Yeah.
are major U.S. cities headed for a doom loop? Oof.
Well,
Um,
um,
answer is no. While facing challenges, cities have proven to be resilient. The answer is not no to all these questions, by the way. So there are some calls for the downside. After worsening significantly in 2020, most of 2021, net migration in the 6 U.S. gateway markets was 17% stronger in 2023 than it was in 2019. So basically, what they're saying is, they're talking about major U.S. cities, but I think in general, I think the downtowns, the CBDs have gotten a lot of flack, a lot of hate over the last couple of years since COVID. Um,
mhm.
the cities are not going away by any means. They're just going to
Yeah.
remain popular places for young professionals, places that do business. There's certainly a lot of competition with the suburbs. The suburbs are going to outpace the CBDs, but wouldn't count all of these major metros out just yet.
but it makes for a juicy
but
headline and a juicy a juicy like color commentary for someone to well, have you been to downtown, insert market here, have you been to downtown Boston? It's a ghost town. Have you but have you been to downtown Chicago? It's a ghost town. Insert your city here, but guess what? If things get cheaper, businesses are going to move in, and that's what's going to be kind of interesting is to see, the decline in office rents, which is not uniform. That could introduce like a lot of new companies that can go downtown that want to be there. There's still plenty of businesses, and as dramatic as the flight from the office was, people. It's not 100%. No one's going to leave the office forever. There's reasons why offices exist, period, and it's not because middle managers want people to be there. So that's my rant.
The crisis the crisis in office, Matt, and then we'll pop into the next question, which is when will the Fed pivot? But it's interesting. Obviously, the issues of the office, people aren't working as much, or they're working more from home, whatever. But there's a couple articles out recently. We're not focusing on them today, but there's actually not enough supply of type of office space that folks want.
Question 9.
Because if you do, yeah, never mind. So we're gonna get to it anyway. I knew I read something about that earlier.
Anyway, there we go.
So number 2, when will the Fed pivot? Matt, I was gonna say we could both give our guesses, but we both read. I know we've already read it. So, what does Cushman & Wakefield say?
Yeah.
According to Cushman & Wakefield, the Fed will pivot in Q2 of 2024, which is exactly kind of when more or less we've been calling that as a recent sort of downturn. I think Q2, end of Q2 specifically, not beginning, is.
That's what I was going to say. Is this like March? Yeah, I think it's closer to June than March. So if they're saying Q2, I don't know if they're, there may be, yeah.
I agree 100%.
I love this structure of this. They ask the question and they just give you a simple answer, and maybe they may be wrong, but it's so satisfying to finally get an answer for some of these questions.
It's satisfying. Yeah, exactly. They could be wrong, but it's at least there's you can put a pin in it, and I respect that.
Yeah.
They're probably gonna get it wrong, and that's okay because they gave it a shot. They're calling for 150 basis points, 1.5% of a decrease in the federal funds rate by the end of 2024. Right now we're at about 5.25 to 5.5, and they're saying 2.5 is a long-term average. And what to watch? Pay attention to the personal consumption expenditures, or PCE index, which is a measure of inflation. Even though that's what the Fed looks at, even more than CPI, they look at both. We're going to see some progress on PCE.
That 2.5.
Yeah.
So
at least.
I would classify Cushman as a recession heavy store. I would say Cushman's they're counting on a stronger recession and lower interest rates. That Reuters piece that we discussed earlier is saying maybe less of a recession and higher interest rates. So it's just interesting how things are really interconnected here.
Cushman, it's a really good point, Matt, because it's all relative and where you're getting your information. Cushman has been more negative on the just commercial real estate outlook, as well as the economy for a while now. They're an outlier of their rent growth projections for 2024, coming in, I believe, a negative 2.5% or -3. They're
-2.3. I think that
-2. So you're right. Yeah, and they were one of the only groups that forecasted
insanity
that much rent declines. Cushman & Wakefield has been having some trouble from a corporate level, just with revenues as volumes are down. There's a lot of large national brokerages that have had a tough 2023. I know Cushman & Wakefield is among them, although they're still doing business. A lot of good folks that work Cushman & Wakefield. But again, we've talked about could the performance of your own business be impacting your outlook? Just that trickle down to the economist that's doing this? But maybe, I don't know. Okay, will we see an avalanche of distress assets in 2024? No. It says, although distress levels will continue to rise, it will not be an avalanche. So they're saying yes, distress, but not necessarily an avalanche. Man, I've seen a couple pieces recently. I think one from CRE Analyst that came out yesterday on LinkedIn that
Yeah,
had
I
a
read
kind
that
of
too.
similar commentary of, saying, the debt mature is it really a debt maturity wall or more of a wave? Certainly there will be these maturities that are happening, but it's not like they're happening all at once. Even looking at a graph that we highlighted and published, way back in June of 2023, Matt, showing kind of the beginning of I would say the beginning of the wave. Actually, I think we
Hmm.
called it, the beginning of like the wave front of
Yeah.
when the maturities would really begin, because there was a so little transaction activity in 2020. And then it started really peaking kind of really throughout 2021, really peaking in Q4 of 2021. A lot of these acquisitions were done with short-term bridge loans. And specifically, in this Cushman & Wakefield piece, they basically say that, if you bought an asset prior to 2019, you most likely will have had enough income growth, net operating income growth, to be able to kind of pass those stress tests, be able to refinance. You'll probably be okay. Now, if you bought an asset, post 2021 using it for a floating rate bridge loan, which a lot of our reporting was really based on that, you might not be in as good of a position. Now, what's been happening with borrowers and lenders is a lot of lenders have been very accommodative to borrowers on these multifamily assets, bridge loans. They're granting extensions, kicking the can down the road. Again, with this idea that I think rates are probably going to come down. Banks really would rather not take over properties and go through that process. It's a lot of work. It's a lot of headache. They would much rather just get their money back and redeploy that capital. And if they have to wait an extra 6 months to do that, that's a much, in their mind, that's
Yeah.
a much better avenue than starting a legal process, which can get caught up in the court for, months, if not years. Now, what
Hmm.
we've been saying is that can only go on for so long. And if rates do stay higher for longer, or if the volume of distress hits a certain point, banks may be forced to make some decisions to begin foreclosure processes. And then we'll really start to see some distress. We've already seen distress in the market. Major portfolios have been wiped out,
Hmm.
liquidated in several markets, several large portfolios. And so again, what I think what we've been consistent on is there's no question of if there will be distress. It's more of a question of how much and how
Yeah.
extreme the distress gets.
It was a little funny to read, like, there's not gonna be a wall. Well, it's more gonna be like a wave or a wall. Like, if we're kind of
It's like,
quibbling a little
okay,
bit over
and I'm like,
vocabulary.
I don't think we ever called it a wall. I think someone took our
We,
graph and
I
called it a
just,
wall.
I was
What did
looking,
we
I was
call it?
looking it up.
What did
We
we call it a
said,
wall?
now and we're not
What did we
wrong.
call it?
We called the loan maturities a wall. We never said that the distress was a wall. We said a wall of debt maturities quickly approaching.
Yeah.
This was in our multifamily update for multifamily. But now that's true. Those maturities,
Well, there's
they look
billions
a
that
whole
have,
lot like a
yeah.
wall to me. But distress, that could be more of of a rising action of a wave rather than maybe just like
And I
instant
think that's exactly what you
cranking it
said,
up.
Matt. And
Yeah.
I would go back to go to greatcapitalllc.com/report. Download the original loan maturities report, Matt, that we put out
Yeah.
last year. I think it really details, really specifically, in laying out a number of scenarios of saying, look, the distress is unknown. The banks are probably going to be able to kick a lot of this down the road, but there's definitely a recipe here for some distress. And there's been billions of dollars wiped out already. There's been billions of dollars of investor equity that has just gone away, poof, to zero because of
Hmm.
the loans that they're short-term loans that are maturing. That we saw very clearly that was going to happen. Now, is it leading to a contagion in the rest of the multifamily industry? That's always been the big unknown and the big question. And we've had a little bit of depth just because of the interest of investor interest in multifamily generally.
Hmm.
But that whole piece, again, we're in like, the rough seas. Like they're not.
Yeah.
There's not one way. It's not a wall of water. And it can be a tsunami. I don't think,
But
it's
it is
necessarily
one more
avalanche tsunami.
ingredient. Yeah. Yeah.
But
Yeah.
but the seas are choppy. The seas are choppy. Like, It's not one 10-foot wave, one 20-foot wave. It's like a sea of 10-foot waves, which is
Yeah.
pretty big.
A
Really,
lot of
those are big,
different things that are
big
dragging you
waves.
down. Yeah.
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 Okay, let's get this. Let's go into this. The next question. Matt, of Cushman Wakefield's 10 critical questions. Do alternative
for sure.
sectors have much resilience as we think? Alternatives have unique long-term tailwinds that will require substantial expansion in the real estate footprint. So alternatives are talking about data centers, we're talking about medical office buildings, life science, senior housing, all that stuff. People are excited about a lot of these kind of niche sectors. There are some folks that have been saying they've been maybe a little bit overplayed, especially maybe the data center segment. I've invested in a lot of medical office buildings in the past that have done really well. I think finding some of these niches can be a great strategy, but you can, like, senior housing, being one that, a couple of years ago, was a little bit, got priced to perfection because everyone knew that, the silver tsunami was going to be happening. We're going to need all this senior housing. And so we built a lot of it, anticipating the supply, but not everyone moved out of their houses like on time necessarily.
Yep.
In COVID, made a lot of folks say, maybe I'm not going to actually move to a group home. Now it's catching up. Supply is being absorbed, and people have been doing really well more recently. But you can get in things a little bit early. But I think, especially if you were more of a passive investor, you're not an active operator, even if you are. I mean, this is what I do. I think investing in some of these niche strategies along with your core thesis, for me, core thesis is multifamily, but then, finding a couple of really good operators in some of these niche spaces to allocate to, I think adds a little variety. I think some potential outperformance, get some alpha to your portfolio. Or, if you're you're an operator, GP, and you're frustrated by you can't get any multifamily deals done, or you just want to do something different, you're kind of at an early stage of your career, getting into some of these niche asset classes sooner rather than later could be a great path. And you can really carve out an excellent niche for yourself. And because there's a lot of runway on a lot of these strategies, whether it is MOBs, life sciences, senior housing, et cetera.
Yeah. There's a lot of moving parts to assisted living facilities. That's why I would not want to be an operator.
So your wife knows a thing or two.
That's right.
Some of the facilities, Matt. Yeah. Speaking from at least tangential personal experience.
Yeah.
Okay. So number 5, this is a big one. Everyone is getting excited for, been asking. It's certainly going to be wrong.
Big question. Yes or no?
Yes or no? Will the U.S. fall into recession in 2024? Cushman & Wakefield, what say you? I feel like we're shaking the magic 8 ball, Matt.
That's right. Oh, I have one. I'll bring one next week.
I think you had brought it into the office before. In fact, my daughter got one. Anyway.
Yeah.
Cushman & Wakefield, will the recession fall into recession 2024? Yes. Q1 2024.
That's it.
I think that there should be a magic 8 ball that says yes, no, and then the quarter. That'd be good.
Yeah.
It will.
That's actually really funny.
Wow. Yes. So we're going to fall into a recession in 2024. Why? I don't love, Matt, their reasoning for this, although I don't hate it either. But okay, so there are 25 months is the average number of months it has taken for a recession to begin after the Federal Market Committee, FOMC, Federal Market Committee, kicks off a rate hiking cycle. Except for one time in the mid-1990s, which everyone's pointing to, being like, well, it has happened before. And again, there's only so many examples. So it's like,
I know
there's not enough data points to say yes. But they said yes. Which again, maybe they're going to be right. Only in one time that a recession has not occurred within a 25-month window since the Federal Reserve started raising rates, is what they're saying. Therefore, probabilities says yes. 11 months is the average number of months that the 10-year to 3-month Treasury yield curve has inverted before recession starts. So they're really looking at technical analysis and historical examples. Say yes, it seems like it's, and here's where I do appreciate their take. Is I think that there's a lot of there's recency bias, and there's also a feeling of, well, we made a recession call last year and we were
Yeah,
wrong.
yeah,
I don't want
for
to,
sure.
like, we feel like we're repeating the same mistake we made last year.
Hmm.
And but maybe the call was right last year. It just took longer to get
Yeah,
there. We
it's
talked a
people kind
lot
of
about this
overcorrecting.
kind of time dilation and things just stretching out and taking longer because time was compressed during the pandemic in some weird ways to turn the economy off and try to kickstart it back on. It's the same call. And just because, that, so there, I think 80% of economists that called for a recession in 2023, they weren't wrong that there's going to be a recession. There's always going to be a recession. But I think the timing was off a little bit. And man, again, we're just talking about the difference between a month or two between Q4 and Q1. So I do, but here's what I'm missing. This is what I don't like. Just tell me how it happens. Like
Yeah, yeah,
what's the cause of the slowdown? We
yeah.
just got a blistering hot labor report. Consumer confidence is up.
I don't doubt that things are gonna, yeah,
What
yeah.
is it? I just need to know what's going to
It does seem
change
like,
over the next couple of weeks.
yeah, it does
What
seem
is
like
happening?
they're like, when the lines go this way, there's a recession. They're looking at lines and they're looking at,
Yeah,
um,
exactly. It's all technical.
and it's all yeah, it's all in the abstract. When I want to know, is it toilet paper prices that are going to make everything bad? Like, is a shipping container going to fall into the sea? Like, what's actual real world cause?
Yeah, and maybe commercial real estate, banking crisis. I
Yeah.
mean, so if they were like,
Hmm.
there's going to be a banking crisis because of all of the assets that the banks have, all the treasury bonds that have declined in value, all the commercial real estate, but the Federal Reserve is getting guidance to say, don't mark those assets down, on your
Hmm.
books. So,
Yeah. Yeah.
but at the same time, again, it's an emperor wears no clothes situation. At some point, how much time has to go on until we say, well, how much are those assets actually worth? Like, not, we can't, like, there was no,
Yeah.
the universe can't just like freeze the price of assets. Like, someone could say we're going to freeze these prices of assets, but that doesn't really do that. You just,
Hmm.
that's like by fiat, the government and the federal, someone can say that, but there's always going to be a market there. You can't remove markets. You can't remove, people are going to be under, like, who's going to stop us, Matt, from putting a price on something? They can't. And
Yeah.
so whether
Yeah.
it's a
You're
black
right.
market that
And
exists
that's
or whatever, you can't, like, if at some point it all breaks down.
And that's what I completely agree. There's all this. This is the kind of extending and pretending, and like, well, on the other side of, but there are due dates. That's what this maturity, the maturities are some of them, where like you're gonna have to talk to somebody now. You can't just be inactive and apart from where people think and know that values are. You're going to have to pay your loans. The bank's going to have to take a look at things, and I wonder, if also these businesses that run on loans, are also, going to feel the pressure. Maybe that's another vulnerability, is they puttered along in 2023, but it could just be slowly, their surplus cash could just be slowly degrading and degrading until maybe crisis. Now, that's just a hypothetical example, but it is a fact that interest rates have been higher for the past 2 years than they were, in the past 10 years. So people's different normal is, there's got to be some jarring effect that we haven't seen yet. That's just, I mean, it just, again, I don't know where it's going to hit, but it does, but it makes sense.
I mean,
These calls.
unless, I mean, if rates miraculously just drop to crazy, to not crazy low levels, but just to, where they were a couple of years ago in 2019, so many of these problems may go away, or that's the idea.
Yeah. Yeah.
But real estate markets, they don't work like move on a dime like that. So you still have to you
Mhm.
still have to go up. And then here's really, I mean, riddle me this, Matt. I mean, was there not a period of time in school where your teachers, your parents said, like, Matt, in the real world, you can't turn your homework in late. Like you can't say the dog ate your homework.
Yeah.
You can't like it. They're not gonna can't just get an extension. And you would think, going all the way up the chain where things should get serious.
Yeah.
You know, borrowing millions, billions of dollars serious. You think at that level, it would start to be like, no, you got to turn, you have a maturity date that you have signed on the dotted line. And, so what does it do? I don't know. Maybe we're saying, we should all be flexible and we should be so rigid. And that should be, I can appreciate that. But what does it mean? Why should here? There are certain people that are being held to account that
Mhm.
if they miss a deadline, they're getting thrown, under the bus, or
Mhm.
they're being foreclosed upon, or they're being evicted. But
Yeah. Yeah.
for
Bigger the
people who
problem.
borrow billions of dollars, the bigger the problem. All of a
Yeah.
sudden, it's not a problem. You can just kick the can
Yeah.
down the road and not
Now,
pick up the phone.
and I think you may have mentioned this, but the big question is going to be: is this, are banks going to be under enough pressure where they're like, all right, we can't keep giving you these gimmies? I think we talked about this in, last month, earlier in December, where like, are banks going to reach a point? Is it up to the banks to be like, we can't give you these extensions. We need
Yeah,
you to pay us now because we need to stay solvent.
yeah,
I don't
yeah.
know.
It's a good question. Okay, Matt, we're on to the
This is
next
good.
one.
This makes
Are you ready?
2024 fun. Oh yeah.
I know. Okay. Has the wave of multifamily construction reached its peak? No, not yet, Matt. It is not. Supply side pressure will remain through 2024, but ease in 2025, 26. If you've been listening, you would already have known that. Minus 62% the reduction in construction starts over the past year. That means people are slowing down building things. 3 years, you heard me mention the stat earlier, 3 years is the amount of time that's going to take to absorb at normalized levels the pipeline of projects already underway. So we got 3 years of absorption. But then again, as we get into 2023, we saw this really slow down in terms of starts. And what
Mhm.
they're telling us to watch, Matt, while the multifamily market will likely face supply side pressures in 2024 and the early parts of 2025, the bulk of the supply wave delivered in 23 will continue through the first half of 24, with more than 60% of construction in mid and high rise product supply pressures will remain through 24. Sunbelt metros have the most robust pipelines, but also been the nation's leader in absorption, which means that once the supply wave passes, these markets are primed to outperform.
There's your hill,
Does
or
that make
there's the
sense?
dip. Look on the other
Yep.
side.
Mhm.
Man.
All right.
That
Has the
and
Yep.
also, I like that it emphasized the supply is not going to just suddenly turn off at the end of 2024. It'll bleed over with elevated levels into 2025. They were
Exactly.
pretty emphatic on that.
Yeah. All right, Matt. With industrial demand slowing and vacancy rising, will rents decline? Moving away from multifamily, but I think it's still good to note real quick. No, while rent growth will slow in 24, rents will not decline in the industrial space. So good to know. Anything
I've
of note
been
here, Matt? You want to move on?
I've been looking at, well, there's other, we're not industrial experts, or maybe you are, but I'm definitely not. But I have read a couple reports recently that looked at industrial absorption and rent growth and things like that. It doesn't look like things are headed in as dire straits for the industrial market. And I wonder if there is different pressures, if the supply and demand situation for industrial properties are a little bit different than apartments. Apartments is a more or
Yeah.
less kind of a commodity where you can track population growth and there's things. Industrial, I wonder how much is like, if you build it, they will come, and how
I mean, it's
much
much.
of an
It's
attractant it
so
is.
it's so much more on the business, relying on the business cycle than
Mm.
like apartment and housing demand. Not that housing demand is influenced by the business cycle. Um, so the much of the economy was anticipating a recession, Matt. So there was a little bit of a pullback this last year in
Yeah.
leasing, with a major slowdown. There is a lot of spec industrial that's sitting unleased, but most
Okay.
people
Okay.
believe that that's good. That's going to be absorbed. Build it, they will come, but it may take them a minute if they think of the recession is like next month, and maybe they can get a little bit of a better deal. But if you need the space, you need the space. And again, Cushman Wakefield at least is saying no, rent growth's not going to slow in 24.
Yeah.
You know,
It's
yeah.
interesting.
Oh, sorry, it will. Sorry, rent growth will slow in 24, but it's not going to decline.
Yeah.
So
Yeah. Yeah.
it's going to stay
Slower, but not negative.
exactly. All right, on to the next one, Matt. Will rising consumer debt halt retail's comeback? No, according to Cushman Wakefield, it will not. Although pockets of weakness will emerge, the retail sector's fundamental tailwinds are expected to remain healthy for the next several years. I think a lot of people wrote retail off a few years ago, and especially with the pandemic. I think people have learned that retail is not a monolith, and there's a lot of different ways to skin the retail cat, and there's different types of retail. And so there's a lot of nuance. You're saying you're investing in retail. Are you investing in a mall or grocery anchored retail,
Mhm.
a standalone, pharmacy like a CVS, which aren't doing as well today? Are you investing in a strip mall with some nail salons and some, just some services?
I don't know.
Nearby a Starbucks and a Chipotle, or it's so different, and some of them performed really well, while others have really struggled.
Yeah, well, and e-commerce is a much smaller slice of retail than people may automatically think. People still buy most of their stuff in, brick and mortar, as much as e-commerce has really taken off. And when they're talking about consumer debt and consumer credit and things, and it is not unambiguously disastrous when we're talking about when you're talking about consumer spending or consumer credit specifically. I have right here pulled up the percent change of total consumer credit. Now, I think that that's probably different than revolving credit, but still, the picture isn't dire. It's about we're about at normal levels. Let me share my screen here just really quick, just to
Yeah, go for it.
just to show you. But it's like not it's you can see here. It doesn't look like disastrous. It was peaking maybe in March 2022 with percent change of consumer credit at 10.9%. But right now we are at, as of October, at 1.24%. So it doesn't, I'm not seeing a big steep increase or any kinds of signs of disaster on that level. So that's just, and I've looked into other places like this too, where it comes into either sentiment or consumer spending or something. Things are looking as dire as people would assume when it comes to consumer, when it comes to the actions of consumers. Now, maybe the sentiment is another thing, but even I've heard rumblings that maybe consumer sentiment is turning around. Now I've got to chase that down, but I'll believe that when I see it. People seem to be psyched on being bummed.
Yeah. Well, investor sentiment I know has improved. We looked at that last week, didn't we?
Yeah, that's true.
All right, Matt, let's hopping back into the Cushman and Wakefield piece, the 10 critical questions for 2024. We're getting through them again. These are great questions. We really appreciate them doing this. And we're getting outside of multifamily, talking about other asset classes in commercial real estate. Okay, question 9, which I alluded to earlier. Is there enough office space to meet the flight to quality demand? Which again, this is crazy. There's no one likes office except people who want office and they want a nice place. Now they don't want the old office building in the office park that's been there since the 70s or 80s, but they want that brand new shiny thing with all those cool amenities. So is there enough office space to meet the flight to quality demand? Not long term, not really. There's a limit on the availability of top tier office space, and all right, that whole lot being built right now. There are some office buildings being built, but investors aren't lining up to throw millions of dollars at office right now, even though there may not be enough of the good stuff to meet the demand. According to Cushman and Wakefield, there's just too much consensus that the market will continue to correct, as there's been a decent amount of price discovery now of buildings declining 40, 50, 60% in premier locations in large
Yeah.
metros. So,
That's
I mean,
good.
but
That is really interesting, and we talked about apartments being a commodity versus, maybe industrials, but like I don't it seems like office is less of a commodity. It's not just you need an office. It's like, well, no. If we can work remote, then I'm gonna need something that really draws people, and then maybe paying attention
yeah,
to the office space rather than it just being like a cubicle farm,
yeah,
is gonna be really important. And maybe that means
yeah.
renovations are in the future for some of these office
Mhm.
investors.
Yeah, I think that if a property has the ability to turn itself from B to A plus, but that's the thing though. It's people are looking for top of the line A plus class locations with the location. Um,
Yeah, that's a good
and,
point. Yeah, the
and you
location.
can't always do that. No, you can get pretty close sometimes. And so I think that for the right investors, who are willing to kind of step out a little bit of their comfort zone, I think this could be a really interesting asset class to get into like right now.
Hmm.
Either developing very high end office space or retrofitting existing assets that can be retrofitted to bring it up to that really top tier level. Because so many people are just getting out of the space, they're moving over. They're moving over to retail or industrial, getting out of office.
Hmm.
It leaves a vacuum, which creates an opportunity. Some people are going to make a ton of money in the office
Yeah,
cycle the next couple of
very
years.
good point for sure.
Some people are already losing a lot of money, but when some lose some. All right, Matt, the last question of Cushman and Wakefield's 10 critical questions for 2024. When will we see capital markets turn the corner?
Come on, Cushman.
Okay, what do we
The
think? All right.
innovation is funny. That's good.
Okay, let's see. When we see capital markets turn the corner, best guess, second half of
Even their
2024.
best guess seems pretty definitive. All right, I'll give it to
It
them. I
is,
like.
but I do like how they were like they didn't say on some of the other responses it was much more definitive, like the
Yeah.
recession call Q1 2024. But this
Hmm.
is more qualified, not even looking at a specific quarter, but they're like, second half of the year question. I mean, they should have just put a question mark at the end of it. But I think it's a good guess, Matt.
Yeah.
$419 billion. That's the amount of dry powder targeting real estate globally. That goes back to our previous comments, Matt, of like there's a floor to these real estate markets, especially multifamily. People are ready to start buying again. It's going to prevent some of the major price declines, like we're seeing in office, because again, a lot of those investors are looking at multifamily right now. 84% of that's percentage of institutional investors surveyed by Preqin that expect to increase or hold their target allocation to CRE over the longer term. What's that meaning? These big investors, the KKRs, the Blackstones, the big wealth asset management firms, whatever, we're saying no, real estate is still where we want to be.
Yeah.
Nothing has changed. The 1,000+ year track record of real estate being the number one wealth building tool. We're going through a cycle now, which is just what's been happening for the same period of time. The
Hmm.
economy goes through cycles, markets go through cycles. Real estate's no different. Real estate's still great, especially we're looking at an asset class with inelastic demand, such as multifamily. It's absolute need, and we haven't even talked about the demand drivers in multifamily right now, with higher interest rates, a lack of housing, just in general. Not the
Yeah.
right types of housing. Yeah, you got a lot of new luxury apartments, but you don't got any new, kind of the mid-priced apartment opportunities.
Hmm.
So we didn't really get into any of that at all. And the last point is going to return of normalized CRE transaction volumes will require fluid debt markets. I think that
Yeah.
makes sense. Fluid debt markets will finally get some price discovery, and we will be in whatever new normal. But we've been saying new normal, Matt, now for 3 years. I hate the new normal is horrible. This is just it. Can we all just
Yeah.
accept, just be happy with life? This is normal. If it's
I know.
always
Yeah.
normal,
Yeah.
it's never
Well,
normal.
and calling it a new normal is almost like saying, "All right, this is the new normal. The normal. I'm going to wait for
It's
that
old
to
normal.
happen. You're going to be waiting forever because I even think that that Cushman's expectation for 2.5% Fed funds rate is a little bit low. Like it could be hovering closer to 3.5. In which case, what happens? Does that mean that that investors are just going to not transact and keep waiting for 2.5% that doesn't come? I think that there's that part of what's going to happen in 2024 is a realization from investors, whether they're buyers or sellers, that that they can't wait. They can't calibrate based on interest rates that were prevalent in 2012. This is 2024. It's a different environment, and the future is going to be that way for the next 5 or so years. That seemed a little bit more compelling because there hasn't been any, barring, I guess, a recession. There hasn't been any, real reset. And even, I don't know. It just seems like a lot depends on so much depends on recession, and I want to know how much of that is, again, like I said, motivated reasoning. I think that people, institutions, they have this dry powder. They are ready to allocate to real estate, but they're going to do it when they want to. It's not, they don't plan on investing no matter what happens. They're like, we want this, but we're still waiting. And the longer they wait, the more I
think
feel
that's
like
going to
the
be
more
good.
chance there is for valuations to
sentiment.
go down.
I think it's a good point. I see that sentiment shifting a little bit, Matt, to the positive, understanding that maybe we're not at the bottom, but we're close enough to the bottom of where we want to start looking in these opportunities. And again, getting back to the fertility of calling the bottom of a market, you kind of have to be ready to go when things looking are a little scary, maybe not ideal. And I absolutely think we're at that period of time where you want to start jumping in. You want to start making some strategic acquisitions while everyone is believing that cap rates are going to be at 6+ for a long period of time, when, again, understanding that we go through cycles and that there is a floor in the market and interest rates will go down at some point. I see cap rates compressing again, and I see a lot of value being created for those that making some good moves in 2024. By the time when we get the all clear sign halfway through 2025, it's going to be there'll still be good opportunities, but this is where the stories this is where the FOMO is going to be created. People are going to be getting FOMO in 27, 26, 27 of everyone doing the deals in probably halfway through 23 through 24, 25-ish. Felt the same way, in buying in 2017, 18, and 19. Looking at the deals that were acquired in 2012, 2013, 2014. They started buying deals in 2015. Great deals then, but there was a lot of rent growth in kind of that 2014 time period, 2013, 2014. And it was like, oh man, missed out on that. I wish I would have bought in 2012, 2011. And so you kind of have to get in on the train a little bit early, because you can't, because no one's going to project a ton of rent growth in 2 years until it happens.
Well, and the persuasive thing for me, at least if I was looking to buy, is like valuations have declined measurably within the past year, and like that, and it was like what 20, maybe 20% of decline in valuations. Is that going? How much room is there to go? And not only did they decline, but that also, in a normal year, they would be slightly increasing. So so even if they were flat, they could be a deal. That's what I think that kind of makes me nervous too, is like, well, yes, they could fall further, but they've already fallen. So that's an argument in and of itself. I don't know. Especially,
I think
a Fed pivot will soften things, but
if you were catching a falling knife, at least like the knife isn't like it's close to the floor. Like you might miss it a little bit, a little pinprick, but it's not going to like slice the whole hand. Does that make sense? That's probably a bad analogy, but it's exciting. This is investment advice. Great Capital makes offers to invest solely open to accredited investors. Only offer come in the form of a private placement memorandum, but we are excited to put some offerings out into the market here in the near future. not only on the acquisition space, but also our new preferred equity program here at Great Capital, where you can achieve really attractive risk-adjusted returns, distributing, kind of in the mid, kind of the sixes all the way up to 8%, just kind of cash on cash day one. Total returns kind of in the 13 to 16% range. We're sitting right behind the bank, so we're getting paid before the common equity. The value of the deal can actually decline, and we still make our return. It's a really cool setup and government rights and provisions. Get in touch with the Great Capital team to learn more if you're interested in getting on some of these new pref equity deals, which I think is kind of the real sweet spot right now in terms of multifamily.
Mm-hmm.
So, Matt, this is a great episode.
Thanks. Enjoy the sun.
Thank you. Yeah, I'm reporting live from south of the border in Mexico. Still at it though, man. Still tracking the markets.
Oh yeah,
having some fun as well with the family. So appreciate you keeping things moving back up in the North Country at Great Capital headquarters in lovely Indianapolis, Indiana. Make sure you're, if you can, subscribe to the Great Report if you haven't already via the Great Capital YouTube channel. Give us some comments below. What do you think about Cushman & Wakefield's 10 questions answered for 2024? What they get right, what they get wrong? Love to hear your opinions. We'll comment you back, probably feature any good comments on an upcoming episode of the Great Report. Stick around for the next episode. Again, this is why you need to subscribe and hit the bell icon that gives you an alert, because we've got a really detailed apartment list piece that we're going to be diving into for next week. There's going to be more reports that will be coming out. Great Capital working on our own research piece that'll be coming out here shortly. You're not going to miss any of it. If you are serious about multifamily investing, this is the best way to keep in the loop and up to speed. Man, any closing remarks? Anything of note to share?
No, not yet. I think I got it all out of it, but I'm sure there's going to be so many crazy things that happen this week, so I can't wait.
Oh, good.
Well, I'm going to make some crazy things happen, so yeah.
Wonderful.
Much after that.
All right, everyone. I will catch you next week on the Great Report, and Matt, see you soon.
See ya.